Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions and form your own financial conclusions and make your own financial decisions. Today is Wednesday, March 16th, 2022, and this is Blockhead Traders Weekly. In this week's episode, I'm joined by fellow Blockhead trader Viper XL 007. And in this week's episode, we are going to hop back to the world of equities. And I want to take a look at just what Viper and I are kind of trading and what our portfolio is doing. It's been a while since we did that. We've been visiting lots of other topics, but we just want to get back to that. But before we hop to that, I want to give a shout out to the Discord. Link in the description below. You can find a link to our free and open Discord. You can hop in there. You can talk to Viper, myself, a few other Blockhead traders. Let us know what you're trading. Let us know what videos you want to see. Love to hear from you. You can also find a link down there for thetagang.com/sprocket888. It is where I post each and every one of my trades, the good, the bad, and the ugly. But this week's episode, Viper, I really wanted to get back this week to the world of equities and just kind of taking a look at what's going on there. It's been a heck of a market ride, and I'm sure viewers out there are just wondering what are you guys doing? What are you trading? What's going on here? Because we haven't really covered a lot of trades lately. Mostly because we haven't really made that many trades. But I thought we'd just take a little bit here and just talk about what's going on in our portfolios. What are we doing in this market environment? I'll let you kind of go first, Viper.
Yeah. So like you said, it's, I mean, I guess rough is applicable. It's been rough. And so I kind of rethought my strategy for the year. I mean, that was an important, regardless of the market situation. Like I wanted to kind of, at the beginning of the year, lessons learned from the previous year, because obviously for as long as I can foresee, I'm going to be in this learning mode and just iterative improvement, iterative bettering my technique, bettering my, whatever it is, tracking, whatever. So towards the end of January, early February, I started rethinking what I wanted my goals for this year to be. And as I was doing that, obviously things started to slide and we started kind of getting into this bearish market, and just everything around the rate hikes and all that kind of stuff. So I was like, you know what? Laid out my financial plan for the year. And I was like, I got my eyes on some opportunities towards the second half of the year to kind of bring some capital back into my investments and things like that. So given that things are on a slide, I was like, this is probably a good idea, a good time to clean off some debt, pay off a car, that sort of thing. Because up until this point, when things are running, I was able to kind of split, take profits and reinvest, and then split some of those off to extra debt payments. And so then as things slowed down, that opportunity became less. However, just to be clear, to make sure I'm not like propagating some stigma or myth, there's always money to be made in either direction. Literally flip a chart and all of a sudden a short opportunity looks like a long. But I just don't have that, discipline yet to really see it that way, though it is very real, like looking at price action in reverse. So I've kind of, as we all know, a while back, I peeled a portion of my portfolio into crypto. That's still churning and chugging along, and that, I'm still moving that around and getting plays and opportunities there. But for the equity stuff, like I said, I've pulled way back to knock out some debts as an opportunistic thing while the market's figuring itself out. And then I am really just kind of executing then the personal finance plan to kind of slowly roll stuff back in now that those debts are out of the way. So that means I'm really not holding much. I do have some capital that I'm looking probably just for some sort of, mutual fund or something like that, ETF that just kind of set it and forget it for a little bit, on this bare minimum bit that I have in my account. But so other than that, that's about all I have going on. I don't know what's your situation look like.
Yeah. So for me, the 2021 ended pretty well. We did, the year end episode, did the recap. My strategy was really working. And so I kind of entered 2022. I I had the feeling that things maybe were going to be less than rosy. I had a couple of early hedges on in January because the markets were kind of roaring back then. Um, they slipped a little bit, and then they kind of bounced right back, and I got pump faked out. I think we even did an episode on it where I basically closed all my hedges and said, I guess that was it. And then we really just started sliding from there. And this has happened to me in my portfolio and in my strategy. So talking about my strategy, I really just kind of sell premium. I sell volatility, and typically, if the market's going up, I'm selling puts on pullbacks. Um, Sometimes I'll do some strangles where we're selling options on the top side and the bottom side. And every time there's I'll call it a market redirection, or a significant market change, I get stuck in what I call a drawdown period. Now, it's not really a loss per se, because the way that I trade options. And when your options are kind of losing, you can roll them forward. And what'll happen when we get these kind of shifts in direction is I'll end up rolling the options to kind of buy the time to wait for things to kind of pick back up and kind of turn back around. And it usually happens in about a month, maybe 2 months. And that's really the position that I found myself in February and March. Was this drawdown. I don't have any capital because it's all kind of tied up in the open positions that I had going. The difference here this time around is one of the strategies I started deploying back towards the end of last year. If So the idea when you sell options, especially when you sell them naked, you have what's known as buying power expansion. And so as the price declines, your broker needs you to put up more and more capital to secure the trade. And that's usually fine, but in order to support that, you basically can never allocate 100% of your capital. You always have to keep some percentage of that in your account to be this kind of float, this little buffer that helps you go through these drawdown periods. So when the market slides, your buying power decreases because your broker wants more capital to secure your trades. You kind of let that buffer kind of suck up that buying power expansion. As soon as the market kind of goes the other way, volatility starts to contract. You get your buying power back, and your cash kind of floats back up. And I said, you know what I should try to do? I'm going to take all this cash, and instead of holding it in cash, I'm going to try to pick equities that are pretty stable, maybe kind of up and to the right type of equities. Maybe they pay a dividend. And so I started buying straight shares and holding them. And I acquired them through selling at the money puts, so I got a little discount on them. But long story short, in this big market drawdown, turns out those weren't as stable as I thought they might be. And so, these things, the two big ones were Citigroup, and then another public fund, which kind of does covered calls as part of the strategy on the NASDAQ, called QYLD. Pays a lot of dividend, roughly tracks the NASDAQ for returns and things like that. Well, as you know, with the rate hike fears and everything, tech stocks have just been absolutely hammered. With the uncertainty in Eastern Europe and the economy, basically Citi has gotten hammered. And so I kind of got hit with a double whammy. So this thing, which normally would be cash floating my buying power expansion, is equity. And when that equity goes away because it loses value, effectively your cash buffer also gets decreased. And if that's happening at the same time that your trades are going through buying power expansion, your sponge doesn't suck up as much. And so I'm not really in any sort of danger of anything other than I can't trade because most of my capital is tied up in um, buying power expansion and the decline in these equities that I'm holding. And that further got kind of exasperated because on some of my naked puts, because there was such a violent decline, I ended up taking assignment on them, which isn't really a bad thing because anytime that you go and sell a naked put, you're accepting the risk that you could get assigned those shares, and you're doing so at a discount. And so some of these shares, I got a $5, $6, $7 discount on these shares from assignment, but they also declined $10, $15. So uh, I'm really kind of holding a lot of that stuff right now. So let me just take you on a quick show of my actual portfolio here. And so this is kind of what I'm talking about. The way that I group my portfolio is up here at the top, or each of these rows, I group them by option expiration time. And so you can see I've got one set of options expiring March 18th. That's actually this Friday. And it is a deep out of the money call. So this is a covered call that I sold against Roblox. I sold it at the 85 strike. Roblox is trading at like $41. This thing is going to expire worthless. There's like 50 cents left in this premium. That's going to expire. And everything else has been rolled forward that I've kind of have option plays on into April. So I kind of do this typically in the 7 to 14 days to expiration range. I'll start looking for a day when I can roll these forward and collect more premium. And so you'll see this is where I've got some beyond options that I've kicked forward. I have some more Citi that I sold at the money because I still love that financial company. I still think it's going places. And so this is an at the money put that I've been rolling for a little bit, just kind of collecting more and more premium. So should I ever get assigned, I will have covered a lot of decent premium collection. Otherwise, I get to keep all of that if it rallies past that 65 strike. Roku was an earnings play that I probably hung on to it a little too long. It got to about 45% profit. And I was like, oh man, this thing's going to solid gainer. And then it went the other way. And so I ended up rolling it forward. AT&T, this is another holding that I was kind of kicking forward, looking for more shares there to put in my base portfolio, but I'm going to kick that one forward. You can see down here in this unallocated, I'm going to skip over Rocket Labs. This was just I goofed one time when I put this trade. I thought I was putting a trade for 2022. Turns out it's a 2023 options expiration. So that thing's just hanging out for a real long time. Then down here, my unallocated, this is where I keep all of my shares that I'm holding. So I got, a bunch of shares of Citi, LAZR. This LAZR I got assigned from Naked Put that I was selling, collected a good bit of premium to hold them. However, it's really declined from my assignment price, so I'm still underwater on that. Plug Power, that's another one that I got through assignment. Again, collected amazing premiums, but it's kind of underwater, and so I'm just waiting for some of these. Roblox is another one. I need a rally up, and then I can start selling some calls to get them called away from me. But right now, because I'm so far under my break-even price, if I sold a call now and I breached that strike and they were called away from me, I would actually be losing money. So when I do a covered call, I like to always make sure that the strike price that I'm selling is above my cost basis for the shares. And so these are really just kind of stuck in this depressed slide down, and I'm really waiting for them to turn around so I can start selling some calls and try to get them called away from me for a profit and the premium of that call. So the interesting thing here is this middle column here, this percentage gain, this is of the day. And today was a phenomenal day. It was one of those days where when it happens, you're just like, yes. We've been relentless red candle on all these things. Tuesday was the first green candle in a long time, and it was a pretty strong green candle. And today, I mean, look at this. That my Beyond shares were up 13%, Roku up another 13%, Roblox was up 10%. Just all around, the market was fired up today. And there was a Fed meeting. They raised the interest rate by 0.25%. Some people could say that's related, but Viper and I, okay, news is news. It generates volume, it generates trading, but we're always kind of interested in the price action. And so, Viper, I know that you're not really in the market, but I do know that you like to do charting, whether or not you got active trades or not. And one of the great indicators of the health of the market, in my opinion, is the S&P, or at least the general sentiment of the market. People like to talk about the Dow. You read about the Dow on the news. I am personally not a big Dow fan. It's a very limited number of companies that are in there. And I don't believe it really represents the breadth of the market and the sentiment across all of it. And so I really prefer the S&P for that general market sentiment. So I'm going to ask you, have you kind of been looking at the S&P at all, or any of the markets?
Yeah, so I don't watch it as closely, but yeah, like you said, whether it's in the Discord or right here on an episode, when the call for some chart perspective is called upon, I'm happy to dig in and take a look. And then obviously, like we've seen many times in the past on this show, not necessarily the case right now, but it's really always been fascinating to me when we don't sync up on a particular play. You have a delta strike that you've called out, and then we chart it, and then all of a sudden things boop, like magically sync up. But so let's take a look at the S&P from a chart perspective and see what are we dealing with. And I'll preface this by saying, after I've looked at it, today was a good day, but maybe don't count your chickens yet. So,
Fair enough.
But what do we see? So let's zoom in a little bit here. What are we looking for when we're looking at this? So, on a larger scale, obviously we have, let me go ahead and grab a marker here. We obviously have an up. We had a little dipperoo, and then we came up, and now we have a big retrace. So as we're going up here, there's not much to see, not much to talk about. It's particularly this dip, and then obviously this current action that we really want to focus our attention on. And so when we have a large retrace, this is the daily candles. So we're looking at a significant amount of time here. This goes all the way back to the beginning of the year till now. So we've kind of talked about this before, but it's, certainly worth restating. What are the criteria for a particular level? And in this case, we had this first pullback here. This was our first real pullback in a while. And so this pulled back to a particular level here. So let's go ahead and mark that. So that's the level we needed to hold. We pulled back, we got support, we came off of it, we came back, we tested it, we held it, we came back up, and then we can kind of see here that we tried, like this isn't, perfectly to the level, but we tried to swing back up one more time, and then we actually failed it and we lost it. So now the whole game right now, when you lose the previous low, the whole game is regain it and establish support, and then you can say you're back up and running. So what we can see happened here, we lost it, we came back up, we gained it, and then we lost it again. And so then now we're just now, as of today, literally, we've regained it, but we have done nothing to show that it's even tested yet. So we haven't held it, and then we also haven't gotten support yet. And so there's a couple reasons why this is important. One is obviously we're in a downtrend currently. So if we look at a channel here of the downtrend, we'll come over here, and if we mark this channel that we're in, you know, it doesn't look particularly appealing that we're doing anything to break out of the channel. You know, we rose up above the midpoint, got a little support off the midpoint, and then we fell down low, danced around, got rejected off of it, and now we're right on the midpoint of the downtrend channel literally today. So we could very well bounce off of this and continue, lose this level again, and continue going down. So all that is to say that anything's possible, as always, but there are some things to look out for here. You know, there's a lot of things that need to be established in order to be confident in any sort of reversal, because as you dip, you always get a bounce. Everything is very elastic, like we've said before, and after many red day candles, you're going to get a big green one somewhere along the way, even if we're still in a downtrend. That's just the natural oscillation of the market. So the one last thing that I always find very, I don't know, compelling or interesting, and we'll get your hot take, you know, TikTok video meme reaction to when you see this happen. So we're looking at this just trend wise. We see up, we see down, and we really, really want to see back up. So we could find all of these confirmation bias things to getting this back up. However, what's the very first thing you see when we flip this thing? I mean, it looks trend-wise, if you saw this chart, you'd be like, oh yeah, this thing is done. It bottomed out and we're going back up.
Yep.
That's not great when you when this is an inverted chart. If we invert it back, we want to see up, but then you can shake your confirmation bias by flipping it, and all of a sudden you're like, uh-oh. No, this doesn't look like it's ready to come back down. So not scientific, but I like to do that on charts when I start to really feel confident in whatever I'm reading. And then all of a sudden flip it. And do I still feel confident? And literally on this chart, I was starting to feel like, okay, we're breaking back through. We can establish this. We can regain. And then I flipped it and I was like, no way. That looks like she's going up more on the inverted chart, which is really down.
Yeah. So Viper, when you look at it that way, you absolutely have a great point. And I think your technique here is awesome for kind of trying to thwart or at least take the other side of something. So you don't kind of convince yourself of that confirmation bias. I do a similar thing whenever I'm like convinced that something is a certain way, you know, whether it's somebody's opinion or I'm finding myself gravitating to agreeing with one particular side of an argument. I say, whoa. Let me go try to take a look at the thing from the other side of things. Let me go take someone else's perspective. And I try to force myself to go look at that, because it's how you get these alternate data points. And so I think your technique here is spot on. I definitely encourage that in a lot of equities and things. The one thing I would challenge you on a little bit here is this is not an equity. This is an index. And if you take a look at any index over a very long period of time, or even a longer period, not even very long, maybe 5 years, 10 years, they are the type of thing that is always up and to the right. And where it kind of changes is, yes, you get these pullbacks, absolutely, but a lot of times those pullbacks tend to be some percentage off of the high. And then it starts to correct and it starts to kind of reaccumulate value. And so I would say that you're never going to get those full reversals, full kind of position changes that you would see in a regular equity price action when you're dealing with an index.
Yeah, absolutely. And that's a really good point, because like you said, indexes are generally up and to the right because of just all of the various inner workings of economies that are at play in an index. So while what we're looking at here in the inverted chart, like if this was an equity, this tells exactly the tale of something that has been bleeding for a while, found some strong support, and is now going to be off to the races. But we obviously, like you just said, know that that's not particularly the case on indexes. So let's do a little, index index calibrated analysis on that. So we'll flip it back over because we see these big pullbacks in history as it relates to a major event in history, usually, because that's what shakes up the financial markets. So let's drop a couple little price range things here. I think I want to go out. Let's go out to the weeklies because we really want to go back in time here. So we have this current moment in time, which we could call, if we were to imagine ourselves 3-4 years from now, what would we call this exact moment? We'd probably call it inflation correction. And so this inflation correction dip, if this really was the bottom, we'll call it a 12.5% dip. We go back in time here and we have pandemic concerns, fears, first time since 1908, nobody knew what the heck to expect. So we kind of had a pretty major 30% dip here. This was, I would call this fairly unique in the markets as to why, not to normally expect a 30% pullback. But if we go back in time here now, my history book has run out, so I don't know. Well, we have 2008. That's obviously something we remember in the financial housing market. So back then we pulled back 57%. And so if we just kind of keep going back here, grab these big dips, and this was a long one, 2000 to 2003, 50%. Dot-com bubble. So maybe this wasn't as comforting as I expected it to be. But nonetheless, certainly taken to a point as far as, we can clearly see over a very long time frame, there's a very clear pattern of up and to the right. So we'll see. It's definitely important to take all these data points into consideration. One last data point that I know, not a whole lot about is so this is literally me thinking out loud of something I might look into as another data point or contextualization is what I'm noticing here on this linear scale of the chart of the weeklies. We have this almost parabolic curve. And, that's something that seems like it should be somewhat concerning in that it's not sustainable and things need to slow down. So is this peak right here, when we come back 2 years from now and watch this episode, is this peak more like the .com peak where we just really cooled off to get back closer to the curve, or are we just parabolic now? But that was an unplanned, just something that I just saw live right now.
Actually, just real quick, zoom in to probably just before the Corona crash, because there was a similar interest rate kind of fiasco towards the end there of 2018, I believe it was. It's probably that little dip there.
This is October to January 19%.
Yep. So I'm not up on all the historical events, but I do believe that was a similar interest rate and inflation fears.
Definitely worth noting that while the inverted chart is a very fun correction of vision, we also need to account for what this chart is. And so we shouldn't expect to really come back and test, barring, some massive financial crisis, we don't really expect to significantly retest previous levels too much. But we'll see.
So we just wanted to take some time to kind of say, look, guys, it's not always rosy when you trade. Um, I didn't really keep tabs on my YouTube suggestions. I'm not sure if the Lambo Rage and all those type of YouTubers are still in full force, or if they're kind of going back to their hidey hole. Because in a bear market, in a downtrend, it's not as easy to make money. When the markets are going up, you can kind of just throw money at a wall and you probably get lucky. I always think back to I can't remember what the nature of the study was, but there was a study a long time ago, where they tried to have professional people pick stocks, and then they also took a bunch of monkeys and threw darts at the tickers in a paper, and the monkeys did better on returns as far as where the darts hit. So a lot of that kind of methodology kind of can come from, hey, when the tides are rising, all boats raises all boats. But that's not the type of market we always trade in, and so we're just keeping it real here. We're stuck in the muck. Viper's clearing out debts. That's awesome. If you go back and look about our financial preparedness for Are You Ready to Trade, keeping your debt low and keeping that stuff paid off, that's super important. And trading should be done when you have that extra capital to put at that. You got to take care of your other things first. And debt is just not a burden that is fun to carry around. I'm really bored lately because I'm just stuck in these trades, and I really miss the excitement of kind of the in, the out, the ring in the register, watching the tickers go kind of green, watching that theta print. And it's just not the best of times, but hey, that's what it's all about. This is how you learn to trade in all markets.
As a preview for future episodes, maybe that's why you have a chicken.
That's right. So one of the things that I kind of did in a little bit of this downtrend market is I too peeled away some funds from my trading portfolio and went into the world of crypto and gaming. And honestly, it's been kind of entertaining. And I think that's going to be an upcoming series of episodes about wow, what can you do that is kind of fun, kind of entertaining, and kind of not as boring as watching red candle after red candle after red candle when you're long, not short. Guys, I appreciate you joining us this week. If anything we said kind of sparked something, maybe we spoke about something, you're like, what the heck are you talking about? Or maybe we flashed something up on the screen and you're like, wait, tell me more about that. Leave a comment in the description below. Let us know. Hop in our Discord. Just tell us the content that you want to hear about. We'll make it. We haven't got a request lately, but I know there's requests out there. So toss us some content that you want to see, and we'll get to work on it. Aside from that, I hope you guys have a great trading week next week. Hopefully this is the turnaround of some green candles, at least maybe some sideways action. Down action repeatedly is just not fun. It messes with your psyche and your mental games. So good luck out there. Have fun. And remember, think outside the block.